Are you currently eyeballing a BDC stock that has a sky-high dividend yield and you're not really sure how to evaluate it? Then this video is going to be for you. My name is Amos and welcome back to the Dividend Compounder Show. In today's video, we're going to be diving into BDCs, what they are, how they work, and what to watch out for. What you see on your screen right now are all the different BDCs that are publicly traded on the stock market. So what exactly is a BDC? BDC stands for Business Development Company, and as the name might imply, they specialize in funding and supporting other businesses to grow and expand. You know the show Shark Tank, right? It's kind of like that. And if you're not in the know, Shark Tank is a reality TV show where entrepreneurs, like what you see on the right side of your screen, they pitch their business idea to a panel of wealthy investors. The left side, they revert to them as the sharks in hopes of securing funding to scale their idea. Likewise, when we think about a BDC, to gain a stake in the startup or company in question, they give or lend money to them. Now, if you watch that show, you know that the sharks don't invest in crappy or weird companies. They only invest in businesses that have a real potential, that have a real operation or chance at being a 10-bagger. A 10-bagger is a company that grows tenfold in a matter of a few or a handful of years. And they do that because think about it, you wouldn't give a loan out if you know there's a high probability of that business going belly up. What you see on your screen right now are some of the most successful businesses that were backed on Shark Tank. You got Scrub Daddy, which I've never used, but I heard apparently it's superior for hand dishwashing. And then there's Dude Wipes, which would have been perfect for me when I used to spend a lot of my time out in the field in the infantry. And then of course there's a food truck that apparently is thriving and they're crushing it. But going back to BDCs, these companies seeking help from a BDC are not your typical lemonade stand that's barely making money. Instead, they're middle market businesses that are valued for the most part around $100 million to $1 billion. So pretty big. So when you think about a coffee chain, a car wash chain, a software service, or even a medical device company, that's usually the clientele for the BDCs. So by investing into a BDC, you're basically a venture capitalist or even a private equity firm analyst. Not really, but it's not too far removed from the fact, as you can see the definition for a venture capital firm. You could also think of a BDC as a mini ETF, because in their portfolio of holdings of all the businesses that they help out, they have exposure to many different companies across many different sectors and industries. On the left-hand side of your screen is Blackstone Lending, and on the right side is Blue Owl Capital. As you can see, it seems like Blackstone really likes technology and software. Likewise, with Blue Owl, they also like tech and software, but they seem to be a lot more spread out and diversified across different sectors. So now let's talk about how does a BDC make money? So BDCs make revenue through giving a business a loan and making profit off of that through interest or from that equity stake that we talked about earlier. So in a simple way, you can think of BDCs as a money lending service, but with a catch. Because when you think about a traditional bank, if you qualify for a loan, they'll feed your information into their computer and it's either a yes or a no. There's not really wiggle room for a gray area. Meaning, if you qualify for a loan through a traditional bank, they're going to be more than happy to hand you over some debt and then expect you to pay that loan back on time. However, when it comes to BDCs, they actively mentor and support the business leaders that are a part of their portfolio. And that's because a BDC has commitment to see that their portfolio business should thrive and grow, rather than just expecting a paycheck on time. The banks, they don't really care if you're expanding and growing. All they care about is, are you going to pay them on time on the first of every month? What I'm trying to say is that some people have a really good idea that they start up, but they struggle with running a business operation or scaling it in general. And that's where a BDC can lend a helping hand, if that makes sense. So how does a BDC make money? For the most part, you can think of it like this. A BDC borrows money and then lends it back out to that business. Consequently, as you might have guessed, a high interest rate environment is not too friendly for a BDC, such as REITs. REITs are also going through the same setbacks and obstacles because of the high interest environment right now. So why is the dividend yield so freaking high for a BDC? Well, by law, BDCs must distribute at least 90% of their taxable income as dividends to avoid corporate taxes. If that sounds a lot like REITs, then you, sir, probably have two nipples, because you're correct. Because for REITs, they have to pay out 90% of their earnings. For BDCs, it's 90% of their taxable income. That means, for the most part, BDCs tend to be popular with people who favor income right now, that dividend income, rather than growth, because a high dividend yield is the purpose of a BDC. What you see on your screen right now is an ETF that consists of the most popular BDCs, and its ticker symbol BIZD, BIZD. Their average dividend yield right now is 8.5%. On the other hand, when you think about the S&P 500, which we investors refer to as the market, that average dividend yield is usually around 1.4%, just so you can see the comparison side to side. But because they pay out so much of their income as dividends, they usually don't have a lot of cash left over to reinvest, to grow, and to expand. So BDCs usually grow by taking on more loans or issuing more shares outstanding. All that to say, a BDC is very different from how we would look at a normal company, and that their high dividends are intentional by design. Because I'll tell you what, when it comes to a normal company, if I find out that they are diluting the shareholders by issuing more shares almost every single year, then I would qualify them as ugly and disgusting. But for a BDC, that is a part of the game plan. Like, that's normal. So how does one evaluate a BDC? There's a handful of different ways to do it. For instance, some investors consider the price-to-book ratio, which pretty much reflects the value of the BDC's assets and other investments on the balance sheet after you subtract and take away the liabilities. So you would compare the price of the stock that is currently trading for divided by the book value of the assets. Now, in a perfect world, you want to see a ratio of less than 1. If it's less than 1, then it shows that the BDC is undervalued, or that the market feels bearish towards them for whatever reason. Case in point, if we think about Altria, ticker symbol MO, they currently have a PE ratio of an 8. Yes, a single digit number of an 8. So you would either think that it's undervalued or that the market does not like them. So let's do a very quick example with Ares Capital, ticker symbol ARCC, one of the most popular BDC stocks out here. So at the time of making this video, Ares Capital is currently trading for about $23.42. So what we're going to do is divide that by the book value per share. When it comes to BDCs, the NAV per share and the book value per share are the exact same thing in the context of a BDC. And as of right now, that's going to be $19.77. So we're going to divide that by $19.77, and that's going to give us a ratio of a 1.1, which means for Ares Capital, I wouldn't necessarily say that they're undervalued. However, it's probably appropriate to say they're fairly valued, especially when it comes to their price to book value ratio. Now, if a BDC's price to book ratio is near a 2, then that could mean that it's trading for a premium to its book value. You can think of it like Nvidia's PE ratio. Right now, it's about a 50, depending on the day. So if a BDC's price to book ratio is near a 2, then that means that the stock has bullish sentiment and big expectations, or that it's overvalued. Now listen, if you are a value investor like me, then you like good deals. So you probably think that it's as simple as buying a BDC with a price to book ratio closer to a 1. However, the thing is, the price to book ratio is absolutely subjective. A low price to book ratio could be that the BDC is undervalued, right? On the other hand, it could also be that the market associates it with a crap ton of red flags like bad management, poor quality loans, or even high default risk among its borrowers, or that the portfolio is just trash. So when it comes to BDCs, I would take the price to book value ratio into consideration, but I wouldn't let it be the focal or priority metric. Does that make sense? It would be like 5% of the equation. Instead, for me, there are two good ways to see if a BDC is healthy and is good. The first of the two methods is going to be the NAV per share, which is the net asset value or the book value that we just talked about. For normal companies, we look at the free cash flow. For REITs, we look at the AFFO, the adjusted funds from operations. For me, I think when we look at a BDC, we should look at the NAV per share to assess the financial health of that company and to see if the BDC is growing or not, which is a perfect time for me to call out that for a BDC, you do not look at the PE ratio. If you do, you're wrong. That's not the trading multiple that you should care about. Instead, I think it's more appropriate to look at the price to book value ratio. So as we just alluded to, the book value per share, what you see right there on the bottom, is the exact same thing as the net asset value in the context of BDCs. As a refresher so that you don't forget, the net asset value is how much a BDC is worth when you think about their loans and equity stakes while subtracting the liabilities that are on the balance sheet. And then to see if there's real growth or not, you would divide it by the number of shares outstanding because remember, almost every single year, a BDC is going to issue more shares. Let's do a really quick example with Ares Capital. Now, all of this data that you see on your screen right now was extrapolated from their balance sheet. So 2018, what we're going to do is take a look at their total assets, subtracting the total liabilities, which is going to give us the NAV, the net asset value, which is going to be $7.3 billion. And then you're going to divide that by the number of shares outstanding. For 2018, that was 426 million shares. And so the NAV per share is going to be $17.14. Perfect. So what you're going to do is repeat that process for the following year and then the next handful of years as well so that you can see if there is growth or not. And in the context of Ares Capital, it looks like they were doing pretty fine and dandy from 2018 to 2019. It went up by 1.1%. And then during the pandemic, they went down by -2%, which we can give them a pass on. Almost every single industry and sector was pretty disrupted when things were shut down. And then the following year, they rebounded and their NAV per share went from $16.96 to $18.95. So it grew by 11% year over year. And then in 2022, it dropped back down by -2.8%. But overall, I think as a trend, we can conclude, because as of right now in 2024, the NAV per share is $19.77. When we zoom out and look at it in a historical lens, 2018 was $17.14, which means for the most part, Ares Capital is growing their NAV per share, which I would label as a really good thing that you want to see. Now, I'm going to go ahead and put this sample spreadsheet up on the Patreon if you want to play with it or if you want to plug and chug a different BDC. Now, the second way that I like to assess a BDC is by their dividend profile. We're going to continue on with the example with Ares Capital. By law, they have to pay out at least 90% of their taxable income as dividends, right? So judging a BDC from their dividend profile makes a ton of sense to me. If the dividend is growing year over year, if it's consistent, if they can hold that dividend yield steady, that says a lot about the BDC's performance. The dividend is basically the outcome of all the right decisions and moves being made by the BDC. And as for the payout ratio, BDCs all have a high dividend payout ratio because of their 90% situation. So I don't put too much thought into that metric. So looking at Ares Capital, their current dividend yield is 8.2%, which means for every share of Ares Capital that you own, you get paid out $1.92. Pretty darn juicy, can we all agree? When we scroll down and look at their dividend, what I want to see is a trend that is consistent or growing. What I don't want to see are dividend cuts happening every handful of years. So in the case of Ares Capital, it looks like they're not exactly growing their dividend right now because it seems stable at about 48 cents every 3 months. And as we just agreed to, is a solid thing. It's pretty much been 48 cents since March of 2023, which was a slight drop from their high of 51 cents back in December of 2022. But the big picture is what I care about. And as we scroll scroll down to look at the visual graph of their dividends, minus this outlier right here, March of 2015, we're going to look at June of 2015 onwards, 38 cents every quarter. You fast forward throughout the years, almost 10 years, and now it's 48 cents a quarter. So I would label their dividend profile as being pretty good. I can't say that it's excellent, fantastic, take me out to dinner, because it's not growing every single year. As a matter of fact, they go through these periods of droughts where it stays consistent for like 3 to 4 years. Case in point, 2015 all the way to 2018, it was 38 cents every single quarter, and they exhibited another drought during the pandemic, 2020 all the way to 2021, and now they're doing the exact same thing, right? So I think maybe this year and possibly next year it's going to remain flat at 48 cents a quarter, and that's because of the high interest rate environment. I can't blame them. But what we are not seeing is the dividend being dropped every single year or every other quarter. So Ares Capital dividend profile checks out. Their NAV per share checks out. Pretty darn good. Before we move on with the rest of the BDC video, I wanted to give a quick shout out to this TV series that I just binge watched called American Primeval. It's based in the 1800s, and it's about the Utah territory, which I didn't know anything about it. I think I read maybe 1 or 2 sentences from my AP US history class back in high school, but essentially this show depicts the raw reality and the clash between the US Army and the early Mormon settlers, because the Mormons were trying to establish their new Zion, or I guess their little community where they could do what they wanted to do according to their religious beliefs. However, because the Mormons were trying to do that within the United States, well, the United States had a problem with that. So this show goes into the raw details of the battles that occurred between the two, and in the mix of it all were the Shoshones, the Native American tribe that you see on the top of your screen. I'm going to tell you this right now. Absolutely a fantastic watch. 10 out of 10 would recommend if you're into action and you like historical shows. Now, I'm going to be transparent with you. There is one character that is just absolutely frustrating and annoying, but if you can get past her, then I think the show is a real eye-opener about how America really was in the 1800s during the Civil War era. By the way, because the Civil War was going on, the US had to dedicate most of their troops and manpower towards fighting the Confederates. And that's why the Mormons were able to establish their foothold in Utah. I don't want to ruin it for you. Watch the show if you want to. It should be on Netflix depending on where you live. American Primeval. Okay? Now let's go ahead and talk about BDCs and risk. Are they completely safe? Well, to be truthful with you, not exactly. Here's what you ought to consider when it comes to BDCs. Not always, but for the most part, the businesses that do partner with a BDC, they usually have finances that make a bank turn them away. So either their credit history sucks or they have a shaky balance sheet. So as such, nearly every business that walks through the door of a BDC, they're in hopes of a turnaround story with additional capital. On the flip side, as we alluded to earlier, BDCs actively mentor and support their portfolio companies because their success directly impacts the BDC's returns. By changing up a marketing campaign and improving the P&L, that could have pretty big consequences for the ROI, the return on investment. If the BDC is going to take a chance on this company, they at least want to see favorable rewards and returns. Now, after hearing that, you might have some hesitation and be like, dude, a BDC sounds really risky. However, for me, I think that's a good thing. You can call me an optimist or whatever, but I kind of like the fact that a BDC evaluates a potential business to take on more holistically, whereas a traditional bank only assesses their clients by their finances. Sometimes the story behind the numbers is just as important. At least it is for me, and that's why I put a huge factor in criteria to intangibles of a company before I invest into them. And another risk that we want to consider is that BDCs are built upon leverage. And it sounds crazy and counterintuitive to think that a company with more loans is a good thing, as we just learned with the net asset value. But what you should know is that not all loans are made the same. There is an order in which debtors are repaid according to loan type. If a company ever goes bankrupt. Those who hold first lien loans get repaid first, and then second lien, and so forth. As such, good BDCs prioritize handing out first lien loans because they are repaid first in case, if it ever happens, a default. For example, Blackstone Lending, they specialize in prioritizing first lien loans for that added margin of safety. So they're playing the safe game rather than the bigger returns game. And I say that because there are other BDCs that prioritize on more risky loans because, as you may guess, if you are willing to give out loans that are below first lien or second lien, then there's more gains to be made. However, the higher chances of default happening are also there. And that's why when it comes to BDCs, I would argue the larger BDCs like Ares Capital, Main Street Capital, or Blue Owl are slightly more safer. Yes, their entire industry is kind of risky, but within that bubble of risk, I would argue the bigger the BDC, the less risky it is. And I say risky because when you compare their business model to, say, I don't know, like Microsoft or Google, their leverage picture and free cash flow is just completely different. It is so much better in terms of pure financial metrics. However, as we just learned, with a BDC, you cannot apply those same metrics to them. And you might be finding yourself asking the question, so why does a bigger BDC mean less risk? Because think about it. If a loan defaults or that business can't pay for it, the bigger the BDC, they can absorb the loss without significant impact. Think about it. A $25 million loss is barely a dent if they have a $10 billion portfolio. In contrast, a smaller BDC with a, I don't know, 250 or even like $190 million market cap, if they suffer a $25 million loss, they're going to struggle to recover from that. And it's going to be a huge blow to their portfolio. So what was the point of me making this video? If you chose to keep watching, then you should know that I plan on making a BDC rank tier video in the future. You guys seem to love that series, and to be honest, I enjoy it too. It takes like 50 hours for me to film, produce, edit, and get it up, but those 50 hours, I think it's well worth it because it's actually fun to do. However, I wanted to make this video first so that I can speed run the explanation on what I'm looking for in a BDC in that video. Because can you imagine if I spent 20 or 30 minutes explaining what makes a good or a bad BDC? It would be a way too long of an introduction. So if you care at all about the best BDCs going forward, then you should subscribe to this YouTube channel so you don't miss out on that video. If you are the type of person that hates surprises, I'll probably go ahead and post that video sometime this weekend. There you go. You don't have to be anxiously waiting. I love you. Now, of course, there's other things and metrics that you want to look for when it comes to BDCs. The top two that I talked about earlier, I feel like should comprise of 90% of the decision-making process. But what you see on your screen right now are all the different metrics that I would consider when trying to conclude whether a BDC is beautiful or if they're ugly. But the weighting of the criteria itself, I think it's really subjective. So it might be like 1% across the board for each one of these bullet points. But for me, I think the NAV per share, year-over-year growth, and the dividend profile, I still think that should be 90% for my own opinion. Everything else right here should be taken into consideration, but not be the focal point. And before I forget, this last bullet point right here, not all BDCs are created the same. Some of them like to congregate and go heavy in a specific industry or sector, and others like to be diversified across the board. So I think thinking about the holdings and the businesses that a BDC has in their portfolio should be pretty important as well. All that to say, after watching this video, my hope is that you feel more comfortable when it comes to BDCs and their very high dividend yield. That is by design. Some people think BDCs are super risky and dangerous, but if you know what to look for, I think they're pretty solid dividend payers. And as we just learned with Ares Capital, during the pandemic, did they cut their dividend? No, they continued to pay that very high dividend yield, and it was sustainable. It was like, what, 8, 9, or 10%. But I can't say that was true for all BDCs, but I don't want to get too ahead of myself. You're going to have to find out during the BDC rank tier video. And before I head out, I want to give a special shout out to the Patreon members. Thanks for believing in me. I love you guys. Stay safe, and I'll talk to you next time. Amos out. Woo!